Hello, fellow intelligent investors. My name is René Zollman, and the main purpose of this channel is to educate investors so that they can selectively invest in high quality, superior businesses when they are available at a discount. Because only by buying stocks when they are on sale, you will be able to achieve above average returns. What you should then learn is to be able to control your emotions so that you can hold these businesses for the long term and compound your money effectively. And in this video, I want to discuss the idea of impact investing and to what extent you as an investor can use your money to make a positive impact on society and the world at large. And spoiler alert, I believe that impact investing is a complete fraud, and I will get to that later on in the video. A growing number of investors want to see their money go towards stocks that are not only profitable, but also reflective of their values, their social and ethical values. And indeed, over the course of the last couple of years, the rise of impact investing or responsible investing has been quite remarkable. Responsible investing is widely understood as the integration of A, environmental, B, social, and C, governance factors into investment processes and decision making. Due to these three factors, environmental, social, and governance, responsible investing is also often referred to as ESG investing. And over the course of the last couple of years, this approach certainly gathered momentum. Nowadays, there are many alternative terms that basically describe the same idea. For instance, you will also come across the terms impact investing, sustainable investing, or green investing. According to Wikipedia, impact investing refers to investments made into companies, organizations, and funds with the intention to generate a measurable, beneficial, social, or environmental impact alongside a financial return. But do your investments really have a measurable positive impact? Can you really influence the decisions made within a single company? Or are the terms ESG and impact investing just a fancy marketing label or buzzwords that should attract investors and of course should attract capital? This is what we will discuss in this video, so stay tuned.
Have you ever wondered how you can make your hard-earned money work for you? Have you ever dreamed of building generational wealth and leaving a legacy? My name is René Zollman, and I'll teach you how you can manage and invest your money with confidence, a long-term vision, and without losing your mind. Join me on my journey of intelligent investing and learn how smart people can compound their money effectively and accumulate wealth.
Before I get started, let me just briefly point out that you should consider subscribing to this channel if you want to learn how you can successfully and profitably invest in the stock market. In future videos, I will cover topics such as how to assess whether a management is trustworthy or whether the management team knows how to allocate the firm's capital effectively. We discuss various competitive advantages and outline how you can identify superior business models. Moreover, you will learn how you can determine the actual worth, the so-called intrinsic value of companies, and obviously much more. So if this sounds compelling, you should at least consider hitting the subscribe button because it would help me out a great deal. And with that being said, let's get to the actual topic of this video. In the world of investing, financial newspapers like to put investors into different buckets. They distinguish between growth and value investors, retail investors and institutional investors, traders, and long-term buy and hold investors. I'm not a big fan of this dichotomy. I would refer to myself as a value investor, but my definition of value investing is certainly different to the definition of most financial journalists. Value investing does not mean investing based on low price to book value or low price to sales ratios, which is how most people define it. No, value investing simply means valuing businesses based on current cash flows and expected cash flows in the future. In my view, if you don't understand this principle, you're not investing. Period. But once you have internalized this fundamental principle, there are certainly different value approaches, and all of them can work. For instance, investing philosophies may differ in terms of the level of diversification, the market cap of the companies you invest in, your average holding period and turnover rate, your circle of competence, or whether you short stocks or not. And in addition, I think there's another dimension worth mentioning. Some investors want to make investments that align with their values, and some people want their money to align with a higher purpose beyond profit. As a result, some investors avoid investing in so-called sin stocks. According to Investopedia, sinful stocks are stocks from a company that is associated with or directly involved in activities considered unethical or immoral. Many of these businesses revolve around addiction. Would you be okay with investing in companies that sell tobacco, alcohol, or weapons? What about pornography companies? What about casinos? Is it ethical to take the money of an alcohol addict that keeps buying alcoholic beverages, even though he or she has a serious problem? Clearly, some investors don't think it's an ethical problem to invest in these businesses. In fact, sin stocks' unpopularity may offer above average returns. It may be a good place to find undervalued hidden gems. They may even have a regulatory competitive advantage that protects them from competition. By ignoring sin stocks, you may restrict your portfolio's ability to provide exceptional returns. By contrast, some investors wouldn't feel comfortable being a part owner of such companies. Instead, they wish to support corporations that respond to climate change, maintain some social conscience, treat their workers fairly, and so on and so forth. In theory, there are two ways to go about this. You can either actively eliminate investments that you consider unjust, immoral, or sinful, or you could actively select investments according to specific ethical guidelines. This is what many ESG ETFs promise to do for you. In fact, many investors do want to invest in companies whose values align with their own. So the question I want to answer in this video is whether ESG investing is just a marketing label, just another marketing ploy, or whether you can really have an impact on how our society develops. Personally, I am convinced that it is just another marketing term. I believe that there are several misconceptions about how the stock market works in the minds of retail investors. Whenever I discuss investment-related topics with friends and family, I get the impression that they believe that investing in socially responsible companies can actually have a positive impact. They're always surprised when I explain to them that they are not really supporting the businesses that they chose to invest their savings or hard-earned money in. In my view, boycotting sinful stocks has no impact. Zero. Investors need to understand the difference between primary markets, also known as new issue markets, and secondary markets, aka after issue markets. While the primary market is where securities are created, so you purchase the shares directly from the company, the secondary market is where these already existing securities are traded by investors. Let me illustrate this with an example. Let's consider Joe. Joe runs a vegan hot dog stand. To get started, he needed capital, and so he offered ownership stakes in his company on a public stock market. New equity shares are usually issued via a so-called IPO, initial public offering, allowing investors to buy the stock of a previously private company for the first time. Luckily, Joe was able to find 8 investors who all have received an equal share in his company. Every investor received a 10% stake in Joe's vegan hot dog stand, and Joe still owns 20% of the company himself. At that point, each share of the company is worth $100. Now, clearly all 8 investors had a direct impact on the business operations of Joe's vegan hot dog stand. Now that Joe's firm is a public company, he will have to file annual and quarterly reports, and the cash he collected in the process of going public will be reflected in the financial statements of the company. For instance, you can find the $800 he collected from his investors on the balance sheet. And Joe can use the cash to finance reinvestments in order to grow his business. Now, fast forward 5 years. It turns out that Joe is a great CEO and a great capital allocator. He was able to grow the business significantly. He now owns not only just one hot dog stand, but operates 10 different hot dog stands. And revenue as well as profits have increased 20-fold. Each share is now worth $2,000. Let's assume you are eating a vegan diet because you think that that's the best way as an individual to have an impact on climate change. As a result, you want to support Joe in his endeavor and hope that he can continue to grow his business. You believe that investing in Joe's hot dog stand can make the world a better place. However, what you need to realize is that when you buy a share of his company, you buy it from the secondary market. One of the 8 original investors has to be willing to sell his or her ownership stake. When you buy his or her share for $2,000, only that individual will receive the money. Joe and his business aren't impacted by that transaction at all. Your investment doesn't affect the business's cash flows or its balance sheet. Similarly, to use a real-world example, when you buy shares of ExxonMobil, for example, you are buying these shares on the secondary market and therefore not funding ExxonMobil's operations or impacting the operations in any meaningful way. That's why the place to impact corporations is not the secondary market, but the end market. According to marketlinks.org, the term end market is used to indicate where the final transaction takes place in a value chain. Typically, it is where the end user is located, meaning the individual or organization for whom the product or service has been created and who is not expected to resell that product or service. Consequently, if you don't like what ExxonMobil is doing, you should stop buying ExxonMobil cars. That's where you are going to make an impact on the business. Boycotting their stock really has no impact, and most people misunderstand this. If you want to support Joe's vegan hot dog stand, you can support him by buying vegan hot dogs at his hot dog stands, but not by buying shares on the secondary market. ETFs usually don't buy shares in IPOs, but buy shares in each of the companies that is part of the index on the secondary market. So if you buy shares of the Vanguard ESG International Stock ETF, for instance, your impact on the corporate governance of the underlying businesses is basically non-existent. If you invest a large enough sum, you might be able to increase the share price of a company in the short term. This might have the benefit that if the company issues new shares, they can get capital at an attractive valuation. However, over the long run, stock prices will always reflect the value of the company. And as we stated at the beginning of the video, the actual worth of a company is determined by the performance of the business and the cash flow it generates today and in the future. Before I get to my conclusion, let me ask you, what is your take on impact investing? Do you consciously avoid certain industries? Or have you even invested in ESG ETFs? Do you find it important that you use your money in a way that aligns with your values? Were you aware of the fact that your impact is minimal, if not non-existent? Let me know in the comments down below. And of course, I would also appreciate it if you hit the thumbs up button or share the video with friends and family. So let me wrap it up here. With the wide range of global sustainability challenges on the rise, people are right that they want to make a difference. I do believe in climate change, and I do believe that we need to tackle this and various other problems. But eliminating certain stocks or actively investing in socially responsible stocks is not the way to create a lasting change for future generations. Instead, focus on the end market, or even donate money to certain charities. But ESG investing can certainly be considered big business, just like the term sustainability is a marketing tool for many different enterprises in general. Investment corporations like Vanguard, State Street or BlackRock are using ESG as buzzwords to attract capital and to attract investors. And they use these labels to charge excessive fees for often mediocre products. In the corporate world, the term greenwashing refers to a company's tendency to spend more time and money on marketing themselves as environmentally friendly than on actually minimizing their environmental impact and footprint. It refers to the practice of overstating or otherwise misportraying a company's services or products as being more sustainable than they really are. In a market where consumers are increasingly willing to pay a premium for so-called sustainable products and brands, many companies are intentionally misleading consumers here. And in my view, this phenomenon can also be observed in the world of ESG investing. Investment firms use some well-known concepts, put an acronym on it, and then market it in such a way that many retail investors believe that this is the way to make the world a better place. And then they charge a substantial fee for this. And this marketing ploy has certainly been successful. The number of investors who claim that they pay attention to factors other than pure profitability is growing, and it's growing rapidly. According to the 2018 Global Sustainable Investment Review, sustainable investing assets have grown in all regions ever since 2016. According to the report, Europe accounts for the largest concentration of sustainable investment assets globally, with firms making ESG considerations managing around $14 trillion in assets. From 2014 to 2018, the level of assets under management grew by a compounded annual growth rate of 6%. In the US, assets under management with an ESG mandate held grew at a 4-year compounded annual growth rate of 16% even. Overall, in 2020, ESG investing is estimated at over 35 trillion in assets under management. This represents around a quarter to a third of all professionally managed assets globally. Nowadays, thousands of professionals from around the world hold the job title ESG analyst. And ESG investing is certainly a popular subject of news articles of some of the leading and world-renowned newspapers. So again, this marketing tactic seems to work, but in my view, retail investors lack knowledge and mistakenly believe that they can make an impact by investing in these funds or ETFs. I think this is quite unfortunate because it is often the good people with good intentions that get caught up in some of these mediocre investment products with relatively high fees. Lastly, let me say this. I think it is perfectly fine to avoid some industries. Personally, I feel pride to be a part owner of some of the companies in my portfolio. Similarly, I probably wouldn't feel pride if I would be a part owner in a tobacco company. But I'm very aware that I'm not making a difference by avoiding the tobacco industry. I can make a difference by not buying cigarettes though. And with that being said, see you in the next video. May your finances and investments prosper. Good luck.